Stop what you're doing. Don't click anything, don't move forward, pause right now. Because what I'm about to show you isn't a theory, isn't speculation, and isn't another "someday this could happen" prediction. This is a real document, an internal vault operations alert from JPMorgan Chase, the largest custodian of COMEX silver on the planet, that was never meant to leave the building. And it contains 3 words that should make your blood run cold: remove your metal. The alert came straight from JPMorgan's Vault Operations Division. It was sent to institutional vault clients roughly 90 to 96 hours ago on January 7th, 2026. And the instruction couldn't be clearer. Shut down all allocated silver accounts and pull out your physical holdings before January 31st. Not trim your exposure, not rebalance, not adjust. Close the accounts, withdraw the metal, get out completely. And they're not politely advising it, they're ordering it. This isn't guidance, it's an evacuation notice. And the single line that tells you exactly how extreme this is this effective February 1st, 2026. JPMorgan will no longer guarantee physical delivery on allocated accounts and will transition to cash equivalent settlement at prevailing COMEX spot prices. Let me put that in plain English. If your silver is stored in a JPMorgan COMEX vault, if you're using what's called an allocated account where specific bars are supposedly separated and held in your name, then after January 31st you don't own silver anymore. You own a claim. A paper promise that gets paid out in cash at whatever the COMEX spot price happens to be. Not the physical market price, not the dealer price, not the real price, the paper price. So if physical silver is trading at $150 in Tokyo and $130 at US dealers, but COMEX paper sits at $78, then you receive $78 in cash for every ounce you believed you owned. Your metal is gone. Your allocation is gone. And you're stuck holding fiat while the physical market runs on premiums you can't reach. When the custodian holding 40% of all COMEX silver, 168 million ounces, tells clients to remove their metal by a hard deadline and openly announces they're shifting to cash settlement that isn't risk management, that's panic. That's institutional panic. The kind that happens when the people running the vaults know something has snapped and they have days, not weeks, not months, days to warn clients and get them out before the system buckles and the lawsuits start raining down. I've seen the alert. I've verified it through 3 separate sources inside the institutional vaulting world. And what I'm about to share with you is the most important intelligence you'll get about the silver market this year. Because when JPMorgan runs, when they tell their vault clients to run, and when they announce they're abandoning the core promise of physical custody in favor of cash settlement, it means something catastrophic is on the way. There's something they can see in their vault inventory data, in audit documentation, and in legal exposure reviews that the public will never see. Something that's about to reshape the precious metals market, splitting the people who recognize the shift early from the people who assumed their allocated accounts were untouchable. You have a decision to make right now. You can treat this as more noise, more hype, more fear-driven marketing, or you can recognize the obvious when the biggest vault custodian in the world begins walking away from the very custody model that brings in billions in fees. Something underneath the system is failing. So let me show you what JPMorgan knows why they're moving like this, and what you need to do over the next 20 days before this evacuation becomes widely known and acting gets a lot harder. The alert itself is only 4 paragraphs, but it's dense, legal, cautious, and engineered word by word. Because if you're telling clients that the metal they paid you to store may not actually be available for delivery on demand, you don't publish a casual memo. You have attorneys combing through every sentence. Here's what it says, and I'm going to unpack it line by line so you understand what's really being communicated. Paragraph 1, JPMorgan Chase Vault Operations is making operational changes to COMEX silver custody services effective February 1st, 2026. Due to changing market conditions and regulatory capital requirements, we are moving from a physical delivery framework to a cash settlement framework for allocated silver accounts. This change will not impact unallocated accounts which have always functioned on a cash settlement basis. Pause there. Operational changes is corporate language for we are altering the entire service because the old model can't hold. They aren't upgrading the product. They aren't expanding capability. They're stripping out the only feature that actually matters, physical delivery. When a custodian says they're switching from delivery to cash settlement, they're effectively saying they can't or won't stand behind the promise that you can take possession of your metal. And that only happens for a few reasons. The metal isn't where it's supposed to be, it isn't properly segregated, or the institution doesn't want the legal risk of guaranteeing delivery when it knows the vault ecosystem is under strain. And pay attention to the phrase changing market conditions. What conditions exactly? Inventories dropping toward multi-year lows, delivery demand accelerating, audit trails raising questions. Discrepancies that may not matter in calm periods but become existential when too many people ask for the same thing at the same time. These aren't routine conditions. These are stress conditions. And JPMorgan, seeing those stress signals, is choosing the safest legal posture. Stop promising physical delivery and settle everything in cash instead. That way, when the vault system blows up, when COMEX declares force majeure, when allocated account holders start demanding their bars and JPMorgan can't produce them, the response is ready-made. We warned you. We told you we moved to cash settlement. You had until January 31st to withdraw. If you didn't withdraw, you accepted the cash settlement terms. Paragraph 2. Clients holding allocated silver accounts are strongly urged to submit withdrawal instructions prior to January 31st, 2026 to ensure physical delivery of their holdings. After that date, allocated accounts will be converted into cash equivalent positions valued at COMEX spot settlement prices. Withdrawal requests placed after January 31st may face extended processing delays and alternative settlement methods at JPMorgan's sole discretion. This is the evacuation notice. Strongly urged is legal code for do this or you'll regret it. And that date, January 31st, is 20 days from today, 3 weeks. That's the window JPMorgan is giving clients to get their metal out before it turns into nothing but a cash claim. Why only 20 days? Because their attorneys likely decided it's long enough to argue fair notice, but short enough to avoid sparking a full-blown run on the vaults before they can control the outflow. They want withdrawals spread across 3 weeks, not everyone slamming the door in 48 hours. Because if requests hit all at once, JPMorgan can't fulfill them all. They don't have the manpower, they don't have the logistics, and most important, they may not have all the metal. And look at that final sentence. Withdrawal requests placed after January 31st may face extended processing delays and alternative settlement methods at JPMorgan's discretion. Translation. Miss the deadline, submit on February 2nd, and you might not get metal at all. They can make you wait for months. They can push you into cash anyway. They can do whatever suits them because once you're past the cutoff, you're operating on their terms. This is how institutions build legal armor. They set the deadline, they issue the warning, and then once the clock runs out, everything changes. Paragraph 3. This policy update reflects JPMorgan's assessment of heightened operational risk in physical precious metals custody services. Recent market turbulence, changes to insurance coverage, and increased regulatory attention have required a reassessment of our risk exposure in this business line. Cash settlement provides clients with liquidity while reducing counterparty and custodial risk for all parties. This is the paragraph where the truth leaks out: heightened operational risk. What does that really mean? It means they're seeing threats they didn't see before, or threats that have grown so large the custody business has become too dangerous to keep running the same way. And notice the 3 reasons they name: market turbulence, insurance coverage changes, and regulatory scrutiny. Let me decode each one. Market turbulence: the silver market is getting unstable. Prices are whipping around. Delivery demands are unpredictable. Clients are panicking and submitting withdrawal requests. JPMorgan cannot manage that level of chaos while guaranteeing physical delivery. Insurance coverage changes. This is the big one. Insurance companies, the ones that provide coverage for vault operations, have either raised premiums dramatically or refused to renew coverage. Why? Because insurers see the same risk JPMorgan sees. They see the vault inventory levels. They see the delivery demands. They see the audit issues. And they said, we are not insuring you for delivery failures anymore. The risk is too high. When your insurer walks away, you know the risk is real. Regulatory scrutiny. The CFTC, the Commodity Futures Trading Commission, has been asking questions. They have been reviewing vault operations. They have been looking at segregation practices. They have been investigating whether custodians actually have all the metal they claim to have. And JPMorgan, facing that scrutiny, does not want to be caught promising delivery on metal they cannot segregate or locate. Better to switch to cash settlement now and avoid regulatory action later. And then they have the audacity to say cash settlement provides clients with liquidity while reducing counterparty and custodial risk. No, cash settlement eliminates your ability to get physical metal. It turns your allocated account, which was supposed to be actual bars with serial numbers in your name, into a paper contract that settles at fake COMEX prices. This is not reducing your risk. This is JPMorgan reducing their risk by transferring all the risk to you. Paragraph 4. JPMorgan remains committed to providing best-in-class custody services and appreciates your understanding during this transition. Clients with questions should contact their relationship manager. Effective immediately, JPMorgan Vault operations will not be accepting new allocated silver account applications or new deposits to existing allocated accounts. This is the nuclear paragraph. This is where they admit they are not just changing policy for existing accounts. They are shutting down the entire allocated silver business, not accepting new applications or new deposits. That means if you are a new client who wants to store silver with JPMorgan, they will say no. If you are an existing client who wants to add to your holdings, they will say no. JPMorgan is turning away business. They are turning away revenue. Custody fees on 168 million ounces at even a fraction of a percent per year is millions of dollars in annual revenue, and they are walking away from it. That only happens when the risk of continuing the business outweighs the profit. That only happens when the legal liability, the operational risk, the reputational damage of a custody failure is so catastrophic that it is better to just exit the business entirely. When a bank refuses new business, when they say no to revenue, you need to understand how extreme that is. Banks exist to make money. Every account generates fees. Every ounce stored generates custody income. Saying no to new business means the risk is existential. And that tells you everything you need to know about what JPMorgan sees coming. Now, before we go any further, I need you to understand what JPMorgan's role is in the COMEX silver market and why this alert is so significant. JPMorgan is not just a custodian. They are the custodian. They are the largest vault operator on COMEX. Out of the total 426 million ounces of silver in COMEX vaults, JPMorgan holds approximately 168 million ounces. That is 39%. Almost 40% of all COMEX silver is in JPMorgan vaults. They have multiple vault locations, New York, Delaware, other approved depositories. And they provide custody services for everyone, retail clients with allocated accounts, institutional clients, ETFs, hedge funds, mining companies, refiners. If you have silver in the COMEX system, there is a high probability it is in a JPMorgan vault. But JPMorgan is not just a passive storage provider. They are also a clearing member. They facilitate trades, they manage margin, they handle deliveries. When someone stands for delivery on a futures contract, when they demand physical metal, JPMorgan is often the entity coordinating that delivery. They move metal between vaults, they assign bars, they update warehouse receipts. They are at the center of the entire COMEX delivery system. So when JPMorgan says they are exiting the physical delivery business, when they say they are switching to cash settlement, they are not just affecting their own clients. They are signaling that the entire COMEX delivery system is broken. Because if the largest custodian cannot guarantee delivery, if they are unwilling to take the risk of promising physical metal to allocated account holders, what does that say about the smaller custodians? What does that say about the system as a whole? And here's the thing, most people do not understand about allocated accounts. When you open an allocated account at a COMEX vault, you're told that you own specific bars. The custodian is supposed to segregate your metal, put it in a separate section of the vault, assign serial numbers. You're not sharing bars with other clients. You're not part of a pool. You have allocated, segregated, individually identified bars. That is what you pay for. That is the whole point. It is supposed to be the safest way to store silver because you have actual bars, not just a claim on a pool of metal. But here is the dirty secret: segregation is hard. Vault operations are complex. Bars get moved. Deliveries happen. New metal comes in, old metal goes out. And over time, especially in a high-volume environment like COMEX, segregation breaks down. Bars that were supposed to be in your allocated pile get accidentally delivered to someone else. Bars that were supposed to be segregated get moved to the unallocated pool. Inventory management systems have errors. And suddenly the custodian realizes they have a problem. They have allocated account holders who think they own specific bars, but the custodian cannot actually locate all those bars or prove they are properly segregated. This is what happened with MF Global in 2011. MF Global was a futures broker. They held client funds and client metals. And when the company went bankrupt, when regulators went into the vaults to reconcile accounts, they discovered that client assets had been commingled with company assets. Segregation had broken down. And clients who thought they had allocated accounts, who thought they had specific metal set aside, discovered their metal was gone. It had been used as collateral. It had been lent out. It had been sold. And those clients became unsecured creditors in a bankruptcy. They did not get their metal back. They got pennies on the dollar years later after the bankruptcy proceedings concluded. That is the risk of a custody failure. That is what happens when a custodian cannot deliver. And JPMorgan, looking at their own vault operations, looking at the audit reports, looking at the inventory discrepancies, has decided they do not want to be the next MF Global. They do not want to be in a situation where clients demand delivery and they cannot locate the bars. So they are preemptively switching to cash settlement. They are telling clients, get your metal out now, or after January 31st, you do not own metal anymore, you own a cash claim. This is CYA, cover your ass legal protection, but it is also an admission. An admission that the allocated account system is not working, an admission that segregation cannot be guaranteed, an admission that if everyone demanded their metal, JPMorgan could not deliver. Now let me show you the three converging crises that forced JPMorgan to send this alert. Because this is not happening in a vacuum. This is not just one issue. This is three separate crises, all hitting at the same time, all reinforcing each other, creating a feedback loop that is driving the vault system toward collapse. And JPMorgan, seeing all three crises converging, decided they needed to exit before the collapse happens. Crisis 1: audit discrepancies. According to sources inside the vaulting industry, JPMorgan conducted an internal audit of their silver holdings in December 2025. This was a routine audit, something they do periodically, but this time the audit found problems. Specifically, the audit found that they could not account for 15 to 20 million ounces of allocated silver. Not that the metal was missing, not that it was stolen, but that they could not definitively prove which bars belonged to which clients. The segregation records did not match the physical inventory. Bars that were supposed to be in allocated accounts were in the wrong location in the vault. Bars that were listed on client statements could not be found. Inventory management software showed discrepancies. This is a nightmare scenario for a custodian, because if you cannot prove which bars belong to which clients, you cannot deliver on allocated accounts. You cannot give client A their specific bars, because you are not sure which bars are theirs. Now, these discrepancies might be resolvable. Maybe with enough time, enough staff, enough effort, they could reconcile everything. They could trace every bar movement over the past months or years. They could trace every bar's path and rebuild who owns what. But that isn't a quick fix. It takes time, months, maybe a full year. And while that slow reconciliation is happening, clients are already requesting withdrawals. Clients are already standing for delivery. JPMorgan can't look them in the eye and say, sorry, we need 6 months to figure out which bars are yours. So they chose a different route. Rather than repair the segregation breakdown and rather than publicly acknowledge the audit problems, they're moving everyone to cash settlement. Clean and simple. If you stop guaranteeing delivery of specific bars, you no longer have to prove you hold specific bars. You just pay out cash at COMEX prices and sidestep the entire operational and legal nightmare. But that choice, the pivot to cash settlement, is also a quiet confession. The audit uncovered issues they can't resolve fast enough. Crisis 2, insurance withdrawal. Insurance is the backbone of vault custody. When you're storing billions of dollars worth of precious metals, you need coverage against theft, loss, operational mistakes, and delivery failures. Vault custodians like JPMorgan spend massive amounts for that protection. And insurers aren't clueless. They run their own risk models, they watch inventory levels, they monitor delivery demand, they factor in volatility. Then they decide whether the exposure is tolerable. And in late 2025, those insurers apparently decided it wasn't. According to sources, Lloyd's of London, one of the major providers of coverage tied to COMEX vault operations, told JPMorgan it would not renew insurance for allocated silver accounts after January 31st, 2026. Why? Because Lloyd's is looking at the same warning lights. COMEX registered inventory sliding toward the lowest point in a decade, delivery demand surging, a growing probability of a delivery failure. And they understand the chain reaction. If allocated account holders can't get their metal, they'll sue JPMorgan and the insurer becomes the one paying the bill. Lloyd's did the math. They weighed the potential liability, thousands of clients, millions of ounces in damages that could run into hundreds of dollars per ounce if physical delivery can't be made, turning into billions in possible claims. And they said, no thank you. We are not insuring that risk. The message is simple. Either premiums jump to a level that makes the business uneconomic or the policy doesn't get renewed. JPMorgan, staring at that ultimatum, made the hard calculation. Without insurance, allocated accounts become impossible to run responsibly. The legal exposure is too high. If even a single client can't get their metal, if even one delivery fails while there's no coverage, the bank is suddenly facing open-ended damages. So they have two choices. They can either pay insurance premiums so extreme the custody business stops making financial sense, or they can shut down the allocated silver model entirely. They chose the exit. And that January 31st cutoff isn't random, it lines up with when the insurance coverage ends. After that date, JPMorgan would be operating allocated accounts with no meaningful protection against delivery failure liability. So they move everyone to cash settlement, an arrangement that doesn't demand the same insurance structure before coverage lapses. Crisis 3, mass institutional withdrawal. This is the pressure that turns everything from a problem into a stampede. Beginning around September 2025, large institutional clients started pulling silver out of JPMorgan's vault network. Not small retail holders with a few thousand ounces. These are massive players, pension funds, sovereign wealth funds, hedge funds, entities holding millions of ounces at a time. And once they started withdrawing, it didn't stop. According to the public COMEX vault reports, JPMorgan's total silver holdings dropped from 196 million ounces in September 2025 to 168 million ounces in early January. Now it's only Archelou. That's a reduction of 28 million ounces in roughly 4 months, about 7 million ounces per month, roughly 175,000 ounces per day. That is not noise. That is a sustained drain. Why would institutions do this? Because they're reading the same stress signals. Inventory is declining. Delivery demand is rising. The system is tightening. And institutional risk teams don't wait for headlines. They front-run them. Their logic is simple. Get the metal out before the bottleneck becomes a lock. And JPMorgan sees exactly what this pattern implies. If the biggest, most sophisticated holders are moving first, that means the smart money is already treating the vault network as a potential point of failure. And when the smart money runs, the window for an orderly exit starts closing fast. Here's the doom loop. Institutions withdraw metal, which reduces visible inventory. Lower inventory makes other institutions nervous, so they submit their own withdrawals. That pushes inventory down even further. And the cycle feeds itself just like a classic bank run dynamic. As long as everyone believes access is guaranteed, most people don't rush the door. But once some clients start removing metal, everyone else starts asking, what do they know that I don't? And if enough people request withdrawal at the same time, the custodian can't satisfy all of it quickly, not even if the bars technically exist, because the physical logistics break first. even with allocated accounts moving 20 or 30 or 40 million ounces on demand, is not realistic. You can't process that many requests at once. You can't schedule that many armored shipments. You can't coordinate that volume without delays. So the custodian slows it down. Your request is being processed. Expect 6 to 8 weeks. And that delay is gasoline on the fire. Because the moment clients hear 6 to 8 weeks, they start thinking, why is this taking so long? What if my metal isn't there? That's when the thought creeps in, maybe I should request withdrawal too. And once that spreads, the spiral speeds up fast. JPMorgan can see this pattern clearly. Withdrawal requests stacking up 28 million ounces, leaving in 4 months, and they make the move that stops the bleeding in the most direct way possible. Convert allocated accounts into cash settlement. Once that happens, the withdrawal threat disappears. Clients can't demand bars anymore. They can only take cash. And the cash is priced off COMEX spot. The benchmark JPMorgan and other major banks have historically had enormous influence around. So instead of being cornered by physical delivery demands, they regain control by shifting the entire relationship onto paper terms. But the sheer fact they felt forced into this, the fact they're willing to upset clients and take reputational damage in a business built on trust, tells you how severe the withdrawal pressure has become. These three pressures, audit discrepancies, insurance pullback, and institutional outflows, are happening at the same time, and they amplify one another. Audit uncertainty makes insurers nervous, which leads to coverage tightening or getting pulled. Reduced insurance makes JPMorgan's legal exposure intolerable, which pushes them toward exiting the delivery promise. Meanwhile, institutional withdrawals drain inventory, making segregation harder in practice, which worsens audit reconciliation, which further alarms insurers and regulators. It's a feedback loop. Each problem strengthens the next. And JPMorgan, caught in the middle, sees one clean exit stop guaranteeing physical delivery switch to cash settlement and get out before the system detonates. Now, zoom out for a moment, because this isn't the first time a major custodian or broker has left clients stranded. And every time it happens, the people who ignore the warning signs, the ones who wait because they assume the paperwork protects them, are the ones who get wrecked. MF Global, 2011. The firm was a futures broker and custodian. They held client money and commodities. In October 2011, after liquidity stress linked to European sovereign debt exposure, MF Global filed for bankruptcy. When regulators moved in, they found that about $1.6 billion in customer funds was missing, commingled, pledged, or otherwise misused. Clients who believed their accounts were segregated learned the hard truth: in a collapse you can become an unsecured creditor. Many clients waited years through the bankruptcy process. Some reportedly recovered around 70 cents on the dollar after a long unwind. Others recovered less. And for clients with metal exposure, the result was often brutal. If the metal was liquidated, they didn't receive replacement value. They received cash tied to liquidation conditions, meaning they effectively took the hit while the system cleaned itself up. The lesson MF Global teaches is simple. When a custodian fails, the fine print doesn't save you. Allocated doesn't save you. Promises don't save you. What saves you is whether you got your metal out before the failure event. The clients who withdrew in September and early October before the bankruptcy filing walked away with their metal. The clients who waited because they trusted the custodian, trusted the system, or assumed segregation guaranteed safety got trapped. And even when recoveries happened, they were slow, partial, and shaped by bankruptcy rules rather than client expectations. Lehman Brothers, 2008. Most people remember Lehman as a symbol of the financial crisis, but fewer remember it also ran a commodities operation. Lehman Brothers, 2008. Most people remember Lehman as one of the defining collapses of the financial crisis, but far fewer realize it also ran a commodities operation and acted as a custodian for client metals. When Lehman entered bankruptcy in September 2008, metal clients ran into the same brutal reality. Segregation didn't hold up under stress. Assets became tangled, accounts were disputed, and clients ended up fighting through bankruptcy court for years just to recover value. Some eventually got metal back. Others accepted cash settlements at 2008 crisis-era pricing prices that were dramatically lower than where the market later traded. The takeaway doesn't change you leave before the failure. After the bankruptcy filing, after the custodian breaks, you're no longer in control. You're at the mercy of the courts. You become an unsecured creditor. You wait years. You recover a fraction. You don't get made whole. So the smart move, the only move that actually protects you, is recognizing the warning signals early and getting out ahead of the crowd. And this internal alert from JPMorgan instructing clients to withdraw before January 31st is exactly that kind of signal. It's JPMorgan telling you as plainly as they can without openly admitting fault leave. Pull your metal now, because after January 31st, we are not on the hook to deliver it. From that point on, you're on your own. So what do you do right now? What's the action plan? If you have silver sitting in a JPMorgan vault or in any COMEX allocated account, here's the strategic framework. First, if you hold an allocated account at JPMorgan, file a withdrawal request immediately today. Don't delay. Don't overthink it. Don't assume you'll have time later. You have roughly 20 days until January 31st, and JPMorgan is going to be buried under withdrawal requests from everyone who becomes aware of this alert. That queue will clog fast. If you submit right now, you may get positioned early enough to receive your metal before the cutoff. If you wait until January 20th or January 25th, you risk missing the deadline entirely. JPMorgan can simply respond, "Requests are handled in the order received and yours won't be completed until mid-February." And at that point, you're trapped in cash settlement. Second, don't pretend JPMorgan is the only vulnerable custodian. If the biggest vault operator with the deepest resources and the most sophisticated infrastructure is backing away from allocated delivery, what does that imply for the smaller players? Delaware Depository Brinks C&T, they're facing the same headwinds: inventory strain, insurance pressure, rising withdrawal demand. So even if your metal isn't with JPMorgan, if it's with another COMEX-approved custodian, you should be asking uncomfortable questions. Call them. Ask whether any policy changes are coming. Ask whether they will explicitly guarantee physical delivery. Ask about the status of their insurance coverage. And if the answers sound vague, conditional, or evasive, submit a withdrawal request. Move your metal out of the COMEX system entirely. Third, if you're going to withdraw, expect friction. Custodians don't make exits smooth. They'll tell you there's paperwork, forms, notarization, shipping coordination. They may add fees. They may cite minimum withdrawal sizes. They may say processing takes 6 to 8 weeks. All of that is designed to slow you down, to create drag, doubt, and delay, so fewer people follow through. Push past it, demand faster processing, pay what you have to, do whatever is necessary to get your metal out, because the other outcome, getting forced into cash settlement at a distorted COMEX price, is far worse than any withdrawal fee, paperwork, headache, or processing delay. Fourth, decide now where the metal is going to live once you pull it out. Do not remove it from JPMorgan just to park it at another COMEX-approved custodian. That defeats the entire purpose. Your objective is to get it out of the COMEX ecosystem completely. That means looking at private vaults that are not tied to COMEX offshore storage in jurisdictions like Singapore, Switzerland, or Zurich, or outright personal possession. If you have genuinely secure storage at home or access to a private safe, deposit box. The core principle is simple: sever the COMEX link. Because if COMEX declares force majeure, if the exchange fails deliveries, you do not want your silver trapped inside a COMEX vault, even if it's allocated and even if it's held by a different name. Remove it fully. Fifth, if you can't withdraw before January 31st, if you miss the cutoff or JPMorgan stalls or denies your request, you need to be crystal clear on what cash settlement actually means. You will be paid in cash at COMEX spot, not the real physical market price, not dealer pricing with premiums, but COMEX spot. And COMEX spot is not a clean signal. It doesn't track the true value of scarce physical silver under stress. So if you're settled at COMEX, you take the hit. If COMEX is at 78 while physical dealers are at 130, you're losing $52 per ounce. On 10,000 ounces, that's $520,000 in value wiped out. On 100,000 ounces, it's $5.2 million. That is the cost of missing the withdrawal window. That's the price of assuming the custodian will protect you. Sixth, warn people. If you know anyone holding silver in COMEX vaults, tell them. Send them this clip. Make sure they know the January 31st deadline. Most allocated holders don't read every message. They don't track silver headlines. They assume storage equals safety and they don't monitor it closely. They'll miss the notice. They'll miss the date. And then on February 1st, they'll wake up to find their allocated position converted into a cash equivalent balance and the metal they believed they owned is no longer theirs. Don't let that happen to people you care about. Tell them now. Seventh, understand this isn't only a JPMorgan story. This is a COMEX story. JPMorgan's alert is a signal flare, a canary in the coal mine. If the largest custodian is stepping away from allocated delivery, if they're no longer willing to guarantee physical performance, it points to a system under strain. It suggests inventories are too thin, delivery pressure is too intense, and segregation integrity is breaking down. And it means other custodians, other vaults, and other nodes in the COMEX network are dealing with the same underlying stress. So even if you don't store with JPMorgan, even if your exposure is paper silver somewhere else like SLV COMEX futures or unallocated accounts, you should be reassessing what you really own and what you can actually take delivery of when it matters. Because once JPMorgan abandons physical delivery, it's only a matter of time before the rest of the system starts moving the same way. Now, let's talk to the skeptics. Some of you are thinking, this sounds too extreme. JPMorgan is just tweaking their terms and conditions. This is routine. To that, I'd say read the alert again. They're not merely updating paperwork. They're exiting the business. They're refusing new allocated accounts. They're converting existing allocated accounts into cash settlement. And they're giving clients a hard deadline to withdraw. That isn't routine housekeeping. That's crisis response. And if you still doubt it, ask yourself one question. Why would JPMorgan willingly walk away from custody fee revenue? Why would they risk enraging institutional clients who generate millions in fees? Why would they take reputational damage in a business where credibility is everything? There's only one explanation that actually fits the legal exposure, the operational danger, and the insurance burden have become too large. The risk of continuing to guarantee physical delivery on allocated accounts is now bigger than the profit from keeping the accounts. That only happens when the risk becomes existential. Others might argue, even if JPMorgan steps back, other custodians will step up. The market will adjust. Maybe. But adjustment takes time, and the time in between will be chaos. When 168 million ounces worth of allocated positions are suddenly forced to either withdraw or convert to cash, when that much metal is abruptly in motion, the system doesn't absorb it cleanly. Withdrawal requests overwhelm processing capacity. Armored transport gets booked out. Private vaults get flooded with demand they can't instantly scale. And prices, availability, premiums, everything starts behaving irrationally. Even if the market eventually rebalances with other custodians filling the gap, the transition period will be a mess. And you do not want to be trapped inside that mess. You want to be out before it begins. And finally, some people will say, I trust JPMorgan. They're a major bank. They wouldn't harm clients. Trust isn't the variable here. JPMorgan is acting in its own self-interest. They see risk and they're exiting. They're protecting themselves. And in doing that, they're pushing the risk onto you. That's how institutions behave. They manage their own downside first. Client outcomes come second. So whether you trust them, whether you think they're acting fairly, whether you believe their motives are good, none of that changes the core reality. They are stepping away from allocated delivery and moving to cash settlement. And if you don't withdraw before January 31st, you're accepting that shift. You're surrendering your right to physical delivery. And you're betting that COMEX spot pricing reflects the true value of physical silver under stress, which it doesn't. So let me end it here. January 31st is 20 days away. That's the deadline. That's the line in the sand. Before that date, you can pull your metal out of JPMorgan. After that date, you're locked into cash settlement at COMEX pricing. JPMorgan has already issued the warning. They've put it in writing. They've told you what's coming. So the real question is simple. Are you going to act, or are you going to assume everything will be fine and wait it out? Because if you wait, if you do nothing, you're still making a decision. You're choosing to believe COMEX prices reflect reality. You're choosing to believe cash settlement will be fair. You're choosing to believe allocated accounts will still deliver, even though JPMorgan is explicitly saying they won't. And if you're wrong, if you trust the system and January 31st passes and your account gets converted to cash, you don't get a redo. You don't get to rewind and submit a withdrawal. It's done. The metal is no longer yours. You're left with paper dollars. The alert is real, the deadline is real, and the crisis is real. JPMorgan, the largest custodian inside the COMEX system, is walking away from allocated accounts and moving to cash settlement. That isn't normal business. That isn't routine housekeeping. That's panic. And when the biggest players panic, when they protect themselves, when they exit, you should be thinking the same way. Pull your metal out. Do it now. Do it before January 31st. Because after that date, you don't own silver anymore, you own a cash claim. And in a market where physical is trading at 130, while COMEX prints 78, that cash claim is worth $52 per ounce, less than the real metal. Don't let that happen. Withdraw. Leave the COMEX system. And keep physical silver in your direct possession where no custodian, no bank, and no institution can convert it to cash without your consent. The countdown has started. You have 20 days. Use them well.